if you did okay this week, pat yourself on the back because, wow. COT day, it is. On Friday, we get COT data, and I am so curious about the COT data this week, guys. Check this out. So COT data is not out, so please understand this is the last update here was from August 2nd, so this is old data by now. But last week, what did we see? We saw CHF and JPY heavy buying, right? They closed a lot of shorts, a lot of short squeeze going on. You can bet your bottom dollar right now that at 3:30 to 4 p.m. US Eastern time, I'm going to be going right to the Edge Finder Pro, heading over to COT report and refreshing the page because I am so curious to see what happened with the Japanese yen. I bet you what you're going to have, guys, is a ton of short covering on Monday and Tuesday. So just a heads up, the Japanese yen probably got bought so aggressively on Monday and Tuesday. We all saw that, right? If you've been watching the show, then you're well informed on that because I keep talking about it. On Monday and Tuesday, we saw dramatic buying of the Japanese yen, right? Take a look at this. This is Friday. This is the Monday move, right? Sort of a capitulation move. And in my personal view, could be proven wrong in, today even. But in my opinion, this big move to the downside might have sort of gotten loudest at the end. We accelerated lower. We saw huge fear come into this market. And that is why the Japanese yen got bought so aggressively. Now, you may hear me saying, what do you mean by this thing's going straight down? I'm not saying buy the dollar against the Japanese yen. I'm saying the yen got bought heavily across most currencies. If you want to take a look at maybe this chart is easier to say. The Japanese yen got bought aggressively. I just typed in JPY USD. You could actually reverse it in TradingView, which is really cool. And you can see the Japanese yen got super strong on Monday and has proceeded to, let's hope for market kind of volatility to chill out. Let's hope that that's kind of a short-term high. But we'll see. The thing about this crazy market is that this thing could be shooting up by the end of Friday. We don't know. This market is so volatile and moving so fast that isn't a distinct possibility. And you had, by the way, yen buying was not just against the dollar. Look at this. The yen killed it against the euro this week. Well, not this week, but in the last few weeks, right? The pound yen's been moving lower. We've seen a dramatic shift in the moving averages here even, right? We broke clean through the 200-day moving average. And you very well may get something like this where you get, a bounce and then maybe Japanese yen strength comes back into the picture. It's very much possible. But my goodness, the market is super volatile. We saw the NASDAQ on Monday drop like a rock, almost 6%, and then shoot back up. And actually, this is crazy. But if we were to end where we are right now for the week, we would be about break even on the week from last week's close. Isn't that crazy? But it just goes to show that for me personally, I really like to buy dips when people are absolutely horrified, right? And that's what happened on Monday. You had just a pure fear event. People just absolutely terrified. And when you get that absolute terror coming into the market, oftentimes it causes big margin calls, and those big margins calls cause those moves to accelerate lower. And that's why, if you're on the short side of the stock market or gold market or silver or oil, if you're on the short side of anything, when a market, real market sell-off occurs, that's why you can see the drops are so much faster than the rises. Some people love to short the indices for that very reason. They love to short the indices when they're moving lower because, again, it can create very fast, high risk to reward kind of trades. But to me personally, I've had a lot of difficulty over the years trying to short the stock market. It's a really tricky trade. So I don't personally do that. You know, I know people who like to short, you know, the indices. There are people who can do that well. But for me personally, I like to, when I see market drops, I like to get my cash ready and start looking for good shopping opportunities when I think it's, you know, starting to reach a low.
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
This is what this week told me, okay? This week told me, look at the buying pressure that is in this market. What this week told me is that this market does not give a flying F if it goes down, right? F, by the way, stands for Forex. So this market doesn't care. This market does not care. If you want to go lower, great. There's going to be dip buyers who are ready, and I'm one of them. Now, I'm not saying I'm going to leverage and go all in right here and this thing's going to the moon. That's not what I'm saying. I'm saying that this price action this week told me, yes, sellers have been pushing this thing lower and in control, but buyers put a big thumbtack on this and they said, we are here and we are buying this dip. Okay. So what if though fears overcome buyers at that level and there's not enough and we see this thing break? Well, again, for me, this is actually best case scenario, because for me, what that means low key is, I'm depositing to the account. I like to deposit to the account when the market is reaching new drawdown levels. So whenever we hit like a 10% plus drawdown, the S&P 500, I personally take that as an opportunity to add money to my trading account. I don't add every month. I don't add every quarter. I add to my trading portfolio only when the stock market is down 10+% or more. That's a personal that's a personal plan that I really actually want to make a video about today. Do you guys think I should do that video? I'm trying to think, would it be better for me to do, let me ask you guys in the audience, should I do a breakdown of like my game plan in a bear market today video? So bear market breakdown video, or should I just do a standard analysis video? I'm leaning towards the first one because there's no news today. There's nothing that drastically came out that got exciting. But I kind of want to make that video where I just talk about like how I handled bear markets, because it's a different environment. I think a lot of traders are struggling in this environment because I don't necessarily think we're in a bear market. Technically, a bear market is a 20% or more S&P 500 sell-off, which we're not there yet. But I think I'll make that video today. Bear market breakdown, I think, would be a good video to make. It's something that I've been thinking about internally. You know, I've got a plan that I've always stuck to, and I'd like to talk about that plan. So maybe that's what I'll do today. Okay, so anyways, stock market is down 0.3% here today, just kind of cooling off of yesterday's heat to the upside. And I liked yesterday's price action a lot, but I gotta give it to the bears here. Look what happened last time we got a heater like that. Last time we got this move, my arrogant self made a post and I said, hey, that was my best one-day performance ever, which it was. But then it preceded one of my worst couple days of drawdown that I've had ever either. Not in a percentage basis, but just in a dollar sign amount. I gave back all those gains and I took a loss on that trade. So maybe the lesson learned is don't count your chickens before they hatch, right? Or what's the expression? Don't count your eggs before they hatch, whatever the expression is. You get my point. Anyways, that was one of my best single days, and yesterday was one of my best single days because I'm long this market. I've told you I'm I've shared that with the YouTube channel many times. I'm very long this market. If the market goes lower, I want it to go lower. I know that's confusing because I keep coming back to this topic. Long story short, if it goes lower, I'm looking to deposit more to my trading account. And I discussed this with my wife. You guys want the insight on my conversation with my wife yesterday? I told her about, how I've been going through a drawdown recently, and that's never fun. But, we have this rule. I say we, it's really just me, but my wife is very supportive of it. We have this rule where I only really deposit to the account if the market is dropping. And I have certain levels where if the market drops to, I get permission or like the right to add money to the account and buy stocks that I like. So it's like a psychological trick, which I'll talk about in the video later. It's a psychological thing where, I don't buy the market every month. I buy it when it's down. And that simple psychological trick is a game changer for me. Anyways, the Russell's down 0.25%, Dow is down 0.5%, Nasdaq's down 0.5%, and S&P is down 0.3%. You got gold slightly higher here this morning. Silver is down 0.5%. Oil is about flat, but oil seems to be finding a support level right around this 73 level, which is, a nice start. Dollar index is about flat. We're not getting any economic data this morning, so volatility today, this just goes to show how volatile this market is. Nothing has happened this morning, and the stock market is down 0.5% or less, a little bit. Usually a couple months ago, 0.5% was like the whole day's move. That was, a big deal. Dollar index now, also seeing a lot of volatility. It seems like we found a little bit of a short-term low around this 102.5 level. I wouldn't be surprised. We talked with Miko and Marco yesterday about a possible rebound move on the dollar, 104. I think that's very appropriate because while I'm not necessarily bullish on the dollar, guys, you have to understand the U.S. economic data this week kind of came in clutch. Let me show you the two data points. You guys want to know why the market didn't crash lower this week? Here's why. Presentation one. What's the word I'm looking for? Exhibit one. Exhibit, is that the word? You get what I'm trying to say. The first data point that quote unquote saved the week was PMI services. Services PMI came in better than or as expected. So you got to think about this, guys. On Friday, the market got absolutely terrified by the NFP report that came in really low. Everybody looked at that number and they said, uh-oh, recession. And then what happened on Monday? Market crashes before the market even opens, right? The futures market selling off a cliff, Japanese yen getting super strong. And then out of the shadows comes out like the Batman of the situation, services PMI. Services PMI comes out with, muscles popping out of its chest, right? Just huge. And just says, we got this, 51.4. We're still seeing growth in the services component of the economy. Boom. Market rips. Market stabilizes off of that data point. Services PMI is the forward-looking indicator of what the economy looks like. If everybody's terrified about a recession, and then we get services PMI come in like that, it helps out. Exhibit number two, point number two, okay? Why else did the market not crash this week? From what I can see, unemployment claims. Again, the bad guys, the boogeyman comes out, all spooky looking. And then let's think of another superhero. Let's go Spider-Man. Spider-Man swings through the city, saves the day. Unemployment claims of Spider-Man, right? Comes out better than expected. And the market sighs a sigh of relief, because this was the big one. Because why did the market go up? The market had its best day since 2022 yesterday. Why? on an unemployment claims data point. Are you kidding me? How is that so bullish? I'll tell you why it's so bullish is because the market was so bearish. The market said, oh my gosh, we're going to have a recession. Unemployment data last week, horrible. Jobs added, super weak. And then again, swinging through the city, Spider-Man, aka unemployment claims, come in way better than expected. And the market just goes, we're not dying yet. Are we going to enter a recession at some point? Yes, a recession is a certainty in, business cycles. There's no question it's going to happen. The difference, though, is it going to happen now, and is it impending, and are we all going to just fall off a cliff? That's what the market felt like on Monday. And then on Friday, now we've said, okay, hold up. Data points that came in were not horrendous, and maybe we've stabilized. So the stock market lives to see another day, at least for now, right? Big day yesterday, giving back a little bit of those gains here this morning, but we will see where we end up today. With the volatility index being higher, we could give back half of yesterday's gains. We give back all of it. If it's going to repeat what happened last time we saw this big move, we could see a big drop. But in the longer run, I think some of these indicators were showing, okay, things are okay on the economy front, and maybe we're okay.
I'm still actually watching Nasdaq, US 30, S&P 500, and also gold. Yeah, but things were a bit consolidating here and there, or maybe we can say we had some sort of reversals, which were actually aggressive. But I think it's understandable, especially when the market was, or let's say after selling that much. Obviously, we expect the market to reverse, but mostly before the market reverses, I think we have this type of consolidation before we see a nice push. Everywhere, mostly we get something like that. So at the moment, I feel like, things are not really that bad as we thought. I think maybe it's about maybe a time for us just to wait for the rates cut. I think the market is starting to adjust with that. It's no longer like a recession immediately. And that is a good thing. So I think, we will see a sort of reversal, especially on the indices.
Yeah, I typically agree with you. I think that, we've got rate cuts that are kind of around the corner. The economy this week was under question, and then we had some data points that helped out with that. So we've seen a lot of volatility, a little bit of a bounce back in stock indices as well as gold. I was curious, by the way, what your thoughts on gold were this week. We had quite a move there as well. Big spike up, then a huge drop. By the way, gold spiked initially, guys, on NFP. So NFP actually came out very poor. Markets initially ripped higher on that. But then when fear really settled in, it was a bit confusing for many investors why gold actually dropped very hard. The simple answer, historically speaking, is that when you get real fear in the market, short term, gold can often sell off as people, need to sell it to raise cash in order to cover their margin calls that can occur on a global scale. That's kind of what seems to have happened with gold. But I'm curious, Kenzo, do you think gold has room to go back to the highs here? Or short term, do you see it going lower?
At the moment, I believe that we will see the market going even higher. It seems like the market is still trying to think twice, but obviously we already know that we have the rates cuts, which is going to be a plus on gold. And at the moment, we can also say we have tensions in the Middle East, which seems like things are heating up very quick. And that might also push gold to go even higher. But beside Middle East also, next month is going to be very good for gold. So now, yes, maybe we might find the market trying to reverse here and there. But at the end of the day, I think lower rates, they will favor gold, and gold is going to go very high. I think, let's say this year, up to maybe December there, we might see the market going higher because we expect them to cut the rates throughout the year. If they don't really cut with the bigger, let's say, basis points, if they don't cut with 50 or 75, they might split that and they might maybe start with 25, maybe in 3 times or twice, whatever, but that will be rate cuts. and that will always favor gold. So it will depend, but I think the overall structure to me, it's actually a very nice bullish move.
Yeah, another thing interesting, Kenzo, is if you take a look at my chart for a second. So on the previous push to the all-time highs before this last one, this was July. Mid-July, the market was actually thinking that September we would get a 25 basis point cut from the Federal Reserve.
Yes.
Then over here, what's interesting is that now at current levels lower than that one, right? So lower than where we were at that time, we actually see now the Fed is expected to cut 25 to 50 basis points. It's kind of a toss-up right now for the September meeting. But to your point about with rate cuts in the future expected, we're currently trading at lower levels than we were when we expected just 25 basis points with no chance of a 50. So, in my view, that means that we have room at the very least to go back and retest these highs. We might dip first, we might even retest these lows first, but I see gold personally, like you do as well, higher by the end of the year. And I wouldn't be surprised if by the end of the year we do hit that 2,500 level on gold. And, the thing is, when it goes to 2,500, it's not a question of if, it's a question of when. Now, it could be 3 years from now, or it could be 3 weeks from now, right? But gold goes up over the very long term, but I think it could go up in the short term as well, because rate cuts are expected, and now even more so than they were a few weeks ago. Rate cuts are, with some weaker data in the jobs market, seems very likely that we could get some cuts from the Fed pretty soon. So we'll see.
Yes, you are right on that. Plus, remember, mostly when we are on gold, it's not really the same as the stock market. Mostly the stock market will move from the expectation, what we expect maybe next month. So gold mostly won't move because we expect them to cut the rates. It will definitely move around those times, you see, around that week, because currently for gold to move just because there is rates, mostly it doesn't really happen like that on gold. So we still expect CPI, or let's say in between, we still have enough economic news, which gold is still going to react to, obviously. So the market will be just playing games. That day or that week where we're going to have interest rates, then it's where we're going to see those movements. It's like similar to what I said about maybe tensions in the Middle East. Mostly it won't just trigger the movement. It will start to go up if maybe there is something happening at that time. So quite different from the stocks. The stocks, mostly they just react to mostly our emotions. We think maybe they will cut the rates, and then we start to buy. So on gold, it will react to something that is happening like now. So yeah, I think just because we're expecting, let's say, maybe 50 basis points, I also think maybe these areas might be the lowest level at the moment. So 50, it will be bigger. So which means maybe the market will be almost maybe closer to 3,000, maybe.
Yeah. I wouldn't be surprised by it either. I think that, again, as I mentioned, in the long run, gold typically does go up. And another thing that I think might be worth mentioning, Kenzo, that is important here is that, in recent months and years even, good news in financial data or economic data has been taken as bad news for stocks and gold. I'll give you a quick example. So for a long time, not recently, bear with me on that, if jobs were up aggressively, like if we saw very, very strong jobs numbers for a long time, what that meant for stocks and gold were, this is bad, this is bearish. Why? Because that would lead to interest rates staying high or going higher, right? Because high jobs means high inflation. High inflation means they need to get inflation down by keeping rates high. But now, in recent times, things have shifted. Now, jobs being stable no longer applies to gold and stocks the same way. This is where now I think good news is now good news for stocks, and good news is still bad for gold, right? Because good jobs data points would not be positive for gold because that would hurt the story for rate cuts. So I think that what is kind of interesting here is you might see a lower correlation going forward between stocks and gold, which I just think is interesting because for a long time, it's been these two things kind of have been moving together. Stocks go up, gold goes up. Going forward, it's possible that they both go up or they both, diverge from one another, but I think the correlation will be lighter. What do you think on that?
Yes, you're right. Mostly, if maybe the economy is not performing very well, we know very well that things tend to change. Mostly, yes, when things are going very well, we have positive correlation because the stock market, or let's say the economy, it's not suffering like now. If things are bad, if inflation is higher, so we want lower rates, we want lower prices. But if maybe things start to go like aggressively lower, it's like, no, we don't really like it like that. And that's what we see at the moment. Now, gold is just doing its thing. The stock market is just doing its thing. Dollar index is also just going anyway. So mostly we have this disconnect, but it's because everyone it's hoping for the economy to recover, or let's say we don't really want the economy to collapse, because if the economy collapses, obviously we won't have the stocks or indices. So those indices, or let's say Nasdaq US 30s, they exist just because we have the economy. That ecosystem has to just actually interconnect nicely. If the other one is going lower, it will affect the other one. So actually we need balance. That's why last week NFP, the way it went lower, it's good. Actually, it's good for the stock market, but the way it went lower, it was crazy. That we saw that we see that no, this is not going to be good longer. So that's why we start to have that panic. So we need, actually at the moment, we just need balanced figures from these economic events, and from there I think maybe that will be good going further, because we don't really want to see a recession, even though we can actually avoid it along the way, but we don't really want to see it happen like now.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.